Hello and welcome to our 8th and final class on financial institutions. Last week we started talking about insurance. This week in this lecture we will continue talking about insurance, and specifically we will talk about different types of insurance. Basically, there are 4 large types of insurance: life insurance, health insurance, property insurance, and casualty insurance. As the names suggest, of course, life insurance protects from death, early death, premature death. It also protects against permanent disability when the insured cannot continue working to earn a living. And life insurance in the form of annuities also helps with very long post-retirement life when the insured might not have enough income to support their living expenses. I guess it is obvious that the word protects doesn't really mean that we are somehow protected against death. It is, of course, impossible, but as we mentioned last week, in relation to insurance, protection actually refers to financial protection. So moving on to the next type of insurance, obviously health insurance protects against becoming ill, again in terms of financial protection, when those who are insured in case of becoming ill will get some payouts from the insurance company. Those payouts might or might not be enough to cover the hospital bills. That all depends on the type of policy that the policyholder has. Next type of insurance is property insurance. Again, this is obvious. That protects your property from damage. That might be a house, a car, other property. And lastly, casualty insurance protects from liability for accidentally hurting others or accidentally causing harm to others. Next, let's have a look at more details of each of these 4 types of insurance. Life insurance, for example, can be divided into several types, such as term life. This type of life insurance only covers during a specific term. For example, if someone buys a term life insurance today for a specific term of, say, 15 years, the coverage protects the insured only within this period. If the insured dies slightly after that period expires, the insurance company will not pay anything to the beneficiaries. Additionally, with term life insurance, there is no savings component to this type of insurance. The premiums are relatively lower, but the insured doesn't get anything back from the insurance company by the end of the term. In case of whole life insurance, again, as the name suggests, the coverage is for lifetime until the eventual death of the insured, in which case the insurance company pays to the beneficiaries, to the relatives of the insured. There are also some savings components to life insurance, where after some specified term, the insured can cash out on the whole life insurance policy. And the third main type of life insurance is annuity, which is basically savings for post-retirement life, similar to pension, to ensure that there will be enough income to support the elderly after their retirement. Insurance companies are one type of financial intermediaries because the premiums that they collect are used to make different types of investments. So insurance companies also facilitate this movement and flow of funds. There are actually 2 different types of accounts that the policyholders can maintain. It's more common to have a general account. According to the Insurance Fact Book, total value of general accounts in US, I think it's more than double of the total value of separate accounts. In general accounts, the policyholders don't decide what assets the insurance company invests the money into. In that case, most of the investments are in the form of bonds. That's 69%. With separate accounts, the savers can choose what assets the insurance company invests into based on their risk preference. Currently, most of the funds on separate accounts are invested into stocks. That's about 78% of assets on separate accounts. So these are the details on life insurance. Moving on to health insurance. Health insurance is prone to very significant adverse selection problems because, as we mentioned in the previous class, those who are unhealthy would be much more likely to apply for insurance. That's why individual health insurance is usually very expensive, and most of health insurance policies are actually held as group policies, where usually the employers provide group insurance to all of their employees. Now moving on to property insurance, the details that we want to talk about are two types of property insurance policies, which are named peril policy, which protects only from specified dangers. For example, if I live on a mountain in a cave, I'm not afraid of tornadoes, lightnings, or floods. I would only be afraid of fires. So in order to reduce the premiums, I would only purchase named peril policy with protection only against fires. And an open-peril policy protects against any types of damage except for some specified ones. So for example, if someone lives on relatively elevated ground but not in a cave, they might be afraid of any type of damage to the property except for flooding, because it's highly unlikely on elevated ground. So they might buy open-peril policy protecting against any kind of damage except for flooding. Moving on to casualty insurance, not much to talk about the details. As we mentioned, casualty insurance is protection against liability to others, so it's also sometimes called liability insurance. And another detail for both property and casualty insurance is that insurance companies would have to keep more liquid assets for these types of policyholders because it's more difficult to predict when the losses would happen compared to life insurance, since losses on life insurance are a little bit easier to predict based on age and life expectancy. And lastly, let's talk about some managerial practices that insurance companies implement. We're going to talk about those in light of adverse selection and moral hazard problems. These practices are basically implemented in order to reduce those problems. The first one is screening, which is basically collecting, producing more information about insurance applicants. That is done in order to reduce the adverse selection problem. For example, if I'm applying for health insurance, the insurance company might want to examine my health, do some screening, in order to protect itself from severe adverse selection problem. Another practice is, of course, connecting the amount of premiums with the amount of risk associated with specific policyholders, risk-based premiums. If a policyholder is deemed to be more risky, if a policyholder takes on more risk in his or her actions, then he or she will end up paying higher premiums. That actually helps against both adverse selection and moral hazard problems. Insurance companies also employ some restrictive provisions to discourage the insured from taking on too much risk in their daily activities. That is done to help insurance companies against moral hazard. Another practice used by insurance companies is deductibles. That is a fixed amount by which the claim is reduced. For example, if a deductible on my car insurance is $200, then whatever damage is caused to my car, a claim that I might make is reduced by that $200. So if a small scratch costs $150 to repair, I would have to cover that cost from my own pocket because anything under $200 is not paid for by the insurance company. A similar practice is coinsurance. It's similar to deductibles, but expressed as a percentage of the claim rather than a fixed amount. And lastly, insurance companies also apply limits on the amount of insurance. As we mentioned last week, I wouldn't be allowed to insure my old car, old beater, for an exorbitantly high amount, because that creates an incentive for me to somehow make a claim. All of these last three practices actually help insurance companies against moral hazard problems. And that is all for this series of 8 videos on financial institutions. I hope you guys learned something, and I hope it has been somewhat entertaining. And I wish you all a nice day.